This is Justin Pulitzer. This is my weekend video for the week ending March 1st, 2015. So we're starting out March, and we've done this after a bit of a breakout of range and a bit of a kind of sideways consolidation here. So for me, with SPY, you can see we're coming up to the top of this channel area, and you can see in my charts, I know I have some levels in there, but moves above there in the past here haven't been very sustainable, and they backed off a bit here, but they kind of rode the channel, and then we had a bit more of a steeper correction here to mid-channel, only to come back up, fail again, get in this sideways consolidation pattern, which formed a W, which has now, with a hold of the 50-day, has confirmed higher. So we're kind of coming back up into that area. Now, for the spiders, the expected move based on options pricing is $2.43, which would conveniently take us back up close to this spike high if we got there. The resolution of that would be about 213.08 or 9, and then the move down would take us to 208.23, which is kind of within the reference range of this breakout from these past highs in here. So that's what I'm seeing. I do think that there is some potential that if we get accelerated through this bar, which was sort of this outside reversal bar which took us out of range, the 208.73, that we would come down to test the 20-day moving average. But I think it's also possible for price to accelerate a little bit and maybe even push lower to retest this breakout here in the 206.42s. Now, for me, the absolute must-hold is this 205.38. If we break that, and that's also coincides with the 50-day moving average, then I unfortunately think that the 201.90 might be back in play. I don't know how that would play out, if it would be like a series of a stronger liquidation break lower, but that would be the risk, in my opinion, to the downside. And as you can see, price is getting a little bit steep up here. So I would suggest maybe it would be time to sell some of the rallies if we get up a little bit higher. You can see that we're getting close to that 1.618 fib extension, which comes up to 214.17, and that roughly coincides with these levels and a channel high. So it's conceivable that we ride up here for a little bit longer and do a little bit more of an up move. I don't think the market is really all super-duper bearish just because we had a few days of consolidation, even though Friday's close was a little bit weak. It's still sort of in reference, and it's still above this area. I mean, if you start losing this 210.32, then I would say you should start getting, I wouldn't say panicky, but I would get a little bit cautious because you're taking out a lot of this move. You're moving into this kind of reference area, and you might want to just raise your stops at the very least on some of the longs. So for the week coming, I'm either looking for, like I said, a retest up here of these highs, or kind of a retest into this range of the breakout area. So that's the way I see it, and this is the like I said, the channel top. If you take a look at the ES, this is the continuous contract, not the monthly. You can see it's also struggled anytime it's gotten above this channel high, and we actually did touch it in the continuous contract. It's also potentially possible that we do something like a more sideways consolidation of just like kind of chopping in a narrow range to work off some of this excess, although some of this sideways consolidation, you can see the 20-day moving average has caught up considerably, and the 50 is sort of bending back up and catching up as well. So I actually think that it would behoove the market and the bulls not to do something like, just have this complete blow-off spike. I mean, they would be rewarded with higher prices, obviously, but the sustainability for longer term wouldn't be as obvious to me. It would start looking to me a little bit more toppy, and it is also conceivable that there is some type of sideways chop. We are coming into quarter end, and the big question is are we going to have window dressing and a markup, or is there going to be a lock-in and a pull back into range, potentially to do some very more serious damage to like trend or lower? For me, the jury's still out, although I would say think about this a little bit when I talk about Apple and some of the stocks that have been bigger winners. So we'll come back to that in a little bit. IWM, if there is some type of a, this one held up fairly well also. It's just been in this kind of grind higher, although it is bumping its head up against the backside of this previous uptrend. You can see here it failed, here it failed, here it failed, and up here it's just been riding. So there is room in IWM for the channel, for this channel, obviously considerably higher, up into almost 128s if it were to do it right away. Excuse me. And we do have a fib extension of the 1.272 up at 125s, but it has been limited a little bit. I think that as long as we're over 120.97, the play in IWM is, you should be looking for long. I would say that the concern for IWM for me is if you started taking out this range here of this 120.97 to 119.39. If that breaks, then to me, you have a test of the channel low, which, guess what, coincides with that 117.37, which was the nemesis for IWM for sustainability for quite some time. You can see it could never really sustain moves over. It would try and just come back down. So this, to me, would be an absolute right or right out trade to buy that 117.37, because what was resistance should be support, and I would think strong support. Obviously, that would be a very big move down point-wise, but that to me would set up. So IWM to me is a little less certain than SPY, just because we are middle channel here. So there is obviously more room for that to the upside probability-wise, and room downside, although it is sort of like a coin toss here, 50-50 at this point. The Qs are approaching those all-time highs that everyone talks about on the news, which was the 120.50, which was the 2000.com top. We obviously have a long ways from there because we're only got into 108s, but I do think that it is potentially possible that happens. If there is some type of a pullback in the Qs, the levels that I'm looking for as the keys are 106.25, if it were to do something like, come back here to retest the breakout, with give down to 105.26 and maybe 104.58. If that area here gets taken out, then I think we're talking about a trend retouch, which, if it does take a few days, probably coincides with a kiss of the backside of this previous downtrend and this uptrend line down here in the 102s, which would also be a gap fill. All these numbers always seem to coincide. So that are the Qs. TLT has found traction with a little bit of some look belows below into this channel that I had discussed. I think that the play for TLT is long, just because you're down by these, you're on the channel. If you breach the channel and breach these lows, then I think you have to flip short. So if you take out this 126 area, and I would even be cautious anything below this 127.68, which was this previous spike high, which formed the cup and handle, I would say the move then is down to this 123.15 with potential down to 119.43 if things got really, really steep. That would also roughly coincide here with a more primary uptrend line, which I'm going to put back in as green. It had been gray, which had also been this previous channel. You can see this channel is already coming into play. We kissed the back side of it here, and it kind of looked below and failed, and it bounced up. So anything that would retake into this channel, then I think the channel low comes into play, and that might also come into play with the 119s. So that's what I'm thinking with TLT. For now, long. Anything below here is short. Let's see. Crude oil. Still just kind of meandering and choppy. I think for the longs, you need to take out this 54.24. Anything below there to me is still suspect in consolidation. If you take out this 43.58, I would think that the price in crude would be a pretty large cascade down into probably the upper 30s and maybe even mid to low 30s, just because now it has been consolidating so long. If it breaches the 54.24, then I would say you have some room back up maybe to the to this level here, about to 60. You can see that's a volume distribution, and then maybe up to the downtrend line, which is around $70. You can see this was also roughly, maybe even you get a little. There's not really that much volume here. Maybe there's even some type of a move if there is real strength, and maybe like some crisis in the Middle East up to like the 73 area. You could roughly see that coincides where this really broke down, this 73, 74 area. So that's my thinking on crude. Apple. So Apple has been, as we know, a fairly bullish stock. It's had a rather large move in price as of late, and I had said that I thought anything over this 128.97 kept the sort of this upper resistance bar in play, which at the time was like 135. Now it's moved up to like 137s. Apple, though, has been pulling back. You can see it sort of had this look below into the channel, rejected and failed, but now is kind of closing into that below the body of this bar. So I'm thinking Apple is a little bit vulnerable, maybe down to the 20-day moving average, and also this this sort of up channel that's been drawn from these lows to the pre-earnings high, pre-earning low, this low to the this day, we sold off before earnings, and then it had the gap up. So I connected those, and that would roughly take it down to like 125. It would also be like where this gap fill is. For me, the amazing trade for Apple would be, for a great write or write out play, is if it moved to retest the breakout of this 119.75, which roughly is mid-channel. I would think that is a great place to try write or write out in size. In my opinion, there's a little bit of give that could happen if it's coming down with some tremendous speed. Also, the 50-day will probably roughly catch up to 118.12. So somewhere between 118.12 and this 119.75. The 118.12, by the way, was the gap up high of day for the earnings. So in that area, to me, is a great write or write out. If that fails, then the play, I think, would be to flip short for the gap fill, possibly to this bottom side of the trend line, which would be roughly, the full gap fill really would be 109.14. I'm not sure that you get the full fill, but you could get into the 111s and 112s, roughly where this volume profile kind of gets going here, and where where this more primary trend and lower part of the channel had been. It's also potentially possible that it has some kind of a punch through, just because it did here, but I do think that there would be some interested buyers for people who missed Apple the first time. This probably won't be an easy play down. It is potentially possible, if there is lock-in for the end of the month, that Apple does something crazy, like come down really hard and sell off like every single day, like it did at its last peak, just because there are so many people who would not have caught the top and don't want to give away profits, and they need to lock it in to get themselves paid for the quarter. That, to me, is the biggest risk in Apple right now that I see. They have the iWatch event coming out. There could be some sell the news. I think that's March 9th, and there could be also end of quarter lock-in. So if you've been long this, you've had big gains, I think you got to book some profits, and I think you just have to raise stops and just be careful. I know everyone loves Apple right now. There was a time not so long ago where everyone hated Apple, and that could happen very easily again. Sometimes the market just is technical. I don't think anything fundamentally has changed, although Apple has lost some lawsuits, and like I said, there might be some disappointment. Someone will be disappointed with the iWatch. So just be careful with that one. I do think that longer term, it's potentially possible to go much higher. For the sake of the stock and the health, would love to see the thing test 119.75 successfully, and then it'd come back up to retest the highs and then go higher. Longer term, I am bullish Apple, although I do think it looks like it's potentially a little bit vulnerable with that end of quarter lock-in, and that's just the mechanics of the stock market. It's also possible that managers that missed Apple are like all want to pile in now to make up for lost performance, just to show that Apple was on their sheets for the quarter. That is also possible. This is another scenario. It's just harder to have good trade location first entering here. Where were you down here? Where were you here? Where were you here? Now you're first getting bullish on Apple up here. It gets a little complicated. However, if Apple does wind up taking out these highs, and I would say that this day, this sort of reversal bar day, if it can get back above this 131.60, then I think we are going to get back up and retest this area. So you can play it that way. I would do a defined risk with using calls, maybe call spreads. The premium's been a little bit cheap in Apple. If it's in the mid-20s, it's cheap. If it gets into like the 30s, then it's started to getting a little bit more interesting. Anywhere between 30 and 36 to me is more expensive premium. Anything between 24 and 28, 29 is kind of normal for Apple. So you wouldn't want to be selling puts in that scenario. You'd be looking more to buy calls and call spreads or even butterflies. So that's my thinking on Apple. Amazon is looking fairly bullish. It's just been kind of grinding its way higher. I think that this 408.06 is, if you're long, that sort of should be your target. If you really start losing this, the gap high of day, that wasn't really that gap, but this was really the breakout. You had these few days consolidation and up here and then retest. If you start losing this area to me, this 358.61 to 368.40, then I think the play is probably going to be a little bit more dicey. I would think that area is a good right or right out by the dip area. If that doesn't work, you could see that was also a former trend area. I would say that the stock might want to come down a little bit more firmly into this, into maybe even test into the gap. But I do think that somewhere in here is a good right or right eye type of a play if you had missed the trade. I wouldn't jump in though, looking for this move. You're really just playing for a few more points in the big scheme of things. If you're long, play for it. If you're not, you might want to just say you missed this one. And it's as simple as that. American Express, really been choppy, got into the gap, looked above, kind of sold off Friday with everything late. The key number for me with American Express here is to be above this 81.53. You can see you closed here at 81.59, so just did it. If American Express comes back down between 81.53 and 80.56, anything below here to me is still kind of quote-unquote okay to keep the dream alive, just because that's still above the body and this reference low. But if you get below there, I really think that this stock would have could have potentially a cascade down to retest the old low here of this 77.12, potentially this 76.40 area, like this gap fill area, the 76.32, 76.40. And if momentum is really strong and the market starts really rolling over, then I would say that there's a mini gap fill down in the 72s. I would be a buyer in size down here for right or right out. You can see it also ran into some kind of the trend line buzzsaw here and backed off. So for me, I don't really see a need to be long American Express here. I mean, it's just like there are better names out there. This one has come down a lot. I would love to get it even lower, but if you can take this high here, this 83.38, then I think you will get the gap fill to the 85s and potentially a move to like the 50 to AMA with possibly an overshoot to 87s, which is kind of like where this whole nightmare really began. I would at that point take profits though. So that is my thinking on American Express. One that has been acting much better though is MasterCard. And MasterCard did back off. It broke out. It's now testing its breakout area. If you're long this, you want to kind of use this area as your guide. I would be a stop out if you got it below 88.49. That's really this peak. 89.87 to 88.49 is really the key hold, in my opinion, for the stock. If you want to do a right or right out trade, that's okay. But for me, I'm watching this old high of this 84.75, which also coincides with this. It's not drawn properly, really. All right, I'm going to have to redraw that, but roughly around this 88.75, which would kind of does coincide with this trend line, even though it's not perfectly touching here. But this area to me is a large volume distribution node. It's also a gap fill where this kind of got going, and it's also a reference old highs. So that to me would be a greater right or right out area somewhere in those 84s for a long trade. Visa has that split coming up. There's probably some strength ahead of there. It's been acting well. I think as long as it's over 265.63, that area, I think it's okay. That roughly coincides with this real breakout here. You had some noise above there, but you can see here that's really where that failed, and then when you punch back up through here, that's really what's been important. So that to me would be the first level. If it does something like come down ahead of the split, you want to look for it somewhere on this primary trend line, and that to me would be a good right or right out type of a play. So that's Visa. BABA, again, same BS, has been acting weak. It still has that Yahoo share overhang. I think it's setting up potentially for a good right or right out trade in the 82s. 82.81 was the prior low. I would be a buyer there for a right or right out type of a play for a move like back up to 90. That was my thinking on BABA. BIDU is another Chinese stock that had a had a earnings move down. It filled the gap. It's just been listing lower. So you have some reference lows here. This 99.70 would be a right or right out area. 194.31 to me also is a right or right out area. But if you looked at BIDU on the earnings gap, the low in after hours was 191. I would think that gap fill area would have some muscle memory, so to speak. It's below the channel though, which would make me a little bit cautious. But this would be a good right or right out type of a thing on some type of an overshoot spike. Buy it there. But if you are long this, keep in mind this channel area. I would be very cautious if it gets below that 99.70 low. This is, like I said, a good right or right out area because it coincides with the channel and also this reference low. And if that fails, you might even want to flip short for a move lower back down to those 191s. But this, to me, these are the key levels in my opinion for BIDU. Salesforce.com isn't one I cover a lot. It gapped up on earnings. It's looked fairly strong. I don't know if I'd be a chaser up here with this stock, but if it did do something like pull back to this old reference high of the 67s, that could be an interesting right or right out play. For me, this had been what looked like a head and shoulders setup here. You can see here's the left shoulder, here's the head, and here's the right shoulder. This was a failed play. I was away on vacation this week. I'm sorry I didn't see this. I would have been all over this like a cheap suit as a long. But you can see that it took out this right shoulder here and was holding bullish, and now it's up there. So if you retested the head for me, 64.74, 65-ish, let's call somewhere between 65 and 67, I think you could do something like buy the dip there. It would also coincide with this this had been a cautious uptrend line that was violated, and you could see it held as resistance here a couple of times. Now to me that would be support again, should be support. So that between this zone, preferably on the lower end of it, that to me would be a right or right out play. If it does get up through 71, then you could play it long also, and then use this low of day of 69 as your stop out, which would be the earnings gap range. So that to me is the play for entries on long, either on a correction down to here or a buy over 71 with a 69 stop. So that's Salesforce.com. Facebook, oh man, this thing is just a choppy mess. It has been, it broke out here. It got above the 68, 62. It got to one of my reference highs I had discussed. I had said this I actually drew in here, but I had said about 80, and then I had said that there would be some room to this 81.16, which was a reference level. It got there, and then it backed off. It sold off fairly hard Friday. I think this was just some muscle memory also of people who had been long the stock for a long time, sat through this, didn't sell here maybe, and then they were kind of afraid of this happening again, and I guess that this high here was close enough, so to speak. So I just think that this stock is clearing out some of these old longs who are weak hands, who don't have a lot of conviction. And I had outlined in my last video last week that I thought that there might be a move up to the 1.618 fib extension in the 85s, and then maybe eventually up to 100 if it, which would be the channel high if it took its time on some type of a breakout to, get up through that range. So that's my thinking on Facebook. It's choppy. I think if this reference low here though breaks this 81.10, if you're weak and you don't have good trade location, you might want to get out. Then I think that the channel low and this 50-day moving average might be into play. I had taken some profits up a lot higher. I'm still sitting in a decent part of the position. I had bought over the I discussed this over this day's high, so I have good trade location, and I'm just sticking with this. For me, this is a bit of a longer-term swing. I do think it's going to be choppy. I don't think it's going to be an easy hold. I do think, though, that it will work out in the end. Twitter, again, I had said that this would be choppy. I thought that there would be some resistance up at the IPO area, that $50 area. There was. It's just chopping in range. I think the easier way to play this long is to sell out of the money puts and own the stock lower, or just collect the premium. And we really need to see it have a second back-to-back good quarter. If that happens, then I think the 55.99 is in play. It may even be in play ahead of time if the market gets bullish. And then maybe the 65's up for a gap fill from the Wayback Machine if if they have a second back-to-back good quarter and there's a good reaction, I would think that the move would be then to try to play for the old highs, and that I would be playing that. FireEye, I don't like this management. I've discussed it. I think that there was some news on the tape of insider selling. They, to me, are a not shareholder-friendly bunch. I wouldn't be a chaser up here. If this thing does wind up pulling back, 81.82 is a good reference area to buy the dip. If it doesn't hold there, then I think the channel low would be good, which also coincides with the reference high breakout and a gap fill. I would actually be a buyer down here on this 36 because I'm actually a believer of their story. I believe in them and their CyberArk story. I just don't like the management of this company, but this to me would just be a technical setup that would be too good to ignore. So I would be a buyer down there. CyberArk, I had talked about doubling the range in last week's video. Quite prescient since it absolutely collapsed the next day and is still looking weak. I think you can play it short below this 58.16 area if it came back down there again, and you might want to look to cover a little bit closer to where the gap is. I would be a buyer of this one, though, also, if it did the same thing with as FireEye, got back down to these like 47s area, like close to this gap fill and this reference high. That, to me, would be a good right or right out for a bounce. It might make a lower high, but hey, you might be able to take, 5 points or so or in at that point. So that is CyberArk. Google is another one. I had discussed that this 545.41 was key. I'd actually taken some profits here. I was going on vacation, and I didn't like that it had come back through that breakout. And it turned out to be quite prescient because the stock did come back down lower. While I was away, it did rally. And we are... I did play a little bit long, nothing really worth mentioning. And I did wind up taking some profits at the 200 MA, and then a little bit over here in these 67s for like I think it was 67 to the tick that it was out at. It was a little bit. It did get a little bit higher there. It got to, where did we go to? 69.42. So yeah, it did get it. You could see it got up to this volume distribution. If you're still playing Google long, I think it's okay as long as it holds over this 53. Anything above 54.41 and 53 in between here is a little bit iffy, but I still think would be quote unquote okay. It would just, to me, this is just responsive sellers. We're in a responsive market with buyers and sellers, and I think that as Google moves into the 67.45 up to 77, there's going to be some responsive sellers, and this area is going to be tougher resistance. So I wouldn't actually be chasing Google here after this move up. I would be a buyer, though, somewhere down here on a pullback. So that is Google. Las Vegas Sands is one that just, you were the one, you broke my heart, right? I had discussed it, the failed check back, getting a back above the failed check back, and then it was bull flagging, and then the thing just completely fell apart. Really disappointing move. Luckily, wasn't very expensive. I did play it long, and unfortunately didn't manage this one as well as I should have, probably because I was away. This really should have been the day I was out. I didn't, but we are bouncing back up. If this loses this low, this 54.5, I will be out because these were basically double lows. It would be below trend, and I would be out and just take the loss. I might even flip short for some type of a filling up of the triangle down to these lows here, the 52.28, and maybe even down to 49.82. If we can get back above 57.32, then which would be above this high and this high, then I think you could actually, even if you want to be right or right out, you could add for a gap fill here. But to me, this play is sort of looking a little bit iffy, and I'm just sort of in damage control and looking to kind of get out. So that is unfortunately Las Vegas Sands. Sometimes they don't work out, right? Monster is a monster. This thing took out over the high here. It was holding strong, gapped. It's now above the channel. If you're first entering now, you're I think you're a little bit late to the party. You might want to wait for some type of a pullback to buy the back of the channel here, some type of a fill, at this point. If it does go sideways for a few days and then takes the 143.90, then you could play it long, and then use the low of day, again, that 137.72, as a stop out. You might even, if you're a little bit of a chicken little, you might want to even stop it out below the body here, because to me that would be the body of the candle, because that to me would be a sort of a bit of a fail. If this did do something like fill the gap, It depends on how long it took to do it. If it does it right away, it might be a decent buy. It might be a buy, although I never like to see when things kind of spike and then they fill right away. It to me is a little bit iffy, but it would be a decent right or right out trade. So Monster, not one I really follow, but clearly one that was missed. Netflix, House of Cards 3 out, snowy weekend. Congratulations, Reed Hastings. The stock did just stop shy of this old high, so there's probably some responsive sellers. My thinking here is if you were long, you're being greedy, book some profits. If they do, however, run up back past the reversal day bar, you may see this thing get to 500. That's sort of what I think may happen. That's just like a big round target. If you're long, I don't see why you wouldn't be looking for that. I think a lot of people got shaken out by this move lower and this subsequent break, and then they kind of missed it. This was a professional gap up above the downtrend line. Went higher. I had discussed playing this long. I didn't play this to its fruition, unfortunately, which was, I guess, in hindsight, kind of a little dumb. But I did sell up here fairly well. It did have a pullback, and then it kind of just got, it got going back up to the old highs. I do think, though, that you're being a little bit greedy. Time to book a little bit of profits in a responsive market. If it does do something like pull back here, though, this somewhere between these 48s and these 57s, I think could be a decent buy the dip. There might even be a little bit of press lower to the volume distribution into the 441s. To me, this would be a little bit more of a good level to buy just because you can see where all that volume is. There'll probably be some muscle memory there, and it would also be like 40-something points lower than the high. So that to me is where I would be doing some right or right out play. You can see we're in a bit of an ascending triangle. It started to break a little bit on Friday, so it is potentially possible that it does come back down into this area. You could play that with some type of I discussed this with a put spread or maybe even a put ratio. That to me, how would you do the put ratio, right? So what I would do is I would buy one of these lower strikes, here maybe. You're looking for 57s, you buy that strike, and then you sell 2 times out of the money lower so that you can get the trade on for either zero cost or some type of a slight net credit. That's, to me, how you would do it, and you just could play around with the strikes. Again, you want to do that near dated. I don't think you want to go anything out past, 2 weeks max. That, to me, would be the play for Netflix. If it does have some type of a breakout here, just be call spreads. Call spreads to me would be how to play that. Price line got to the downtrend line like I had discussed it would. It actually stopped short just a little bit of it and is coming back down a bit. If you could break that downtrend line, let me see if I could bring this out a little bit further. I think you will fill up the triangle up here to these 1329s and actually maybe even higher. Let me do a yearly 1 year daily. Wow, this is a long chart. It's been a while, right? I think if you can break this down channel, price line will fill up the gap to these highs here, the 1329s, and maybe even get back up to the 1378s back up here. Just because I do think that the healthiest thing for price line to me would be to do something like this: consolidate sideways, build the pressure. Just because it ran up into earnings, it gapped again, it got to that area. I think that here, really, you can play right or right out short against the high of the day from back here, looking for some type of a fill. So for me, the healthier play would be to buy price line if it consolidated and then took the high, like for a few days and then wham, then you take it. It could also be a good right or right out trade for some type of a partial gap fill to these highs, which is into like 1170-ish, a little bit below there, 1169s, 1154s, like somewhere in this range here to me, which would also coincide with this volume distribution node at 1162 and also the 200-day MA at 1166, which is rising. I think this area to me would be a decent right or right out trade as well. But I would actually, believe it or not, prefer to see the sideways consolidation over the gap high of day range, and then then it take this area and you play it long with like some type of a long call spread or even a risk reversal against the high of day neckline, so to speak. So that's my thinking on price line. Tesla, choppy back into this range. You can see I have tons of reference points here. I think the stock is just going to remain choppy. If it could remain sideways for a while and then take these high, like this reference high here, this like 225.49. You might even want to jump the gun a little bit small over the 218.20. I think if it could do something like chop sideways here for a little while, build a bit of a base, and then take it, then the play would be long. If you start losing this area, though, you know, it is conceivable that it does come back down to the 177s and maybe even at this point overshoots it to get to the down channel. I would be a buyer for me on a break of the down channel or on a test of the low of the down channel. So that to me is the play with the quote-unquote safer play with Tesla. Buy the channel low or buy a breakout of the channel high. Or if you're really ultra-conservative, wait for these reference highs to be taken. And then, you know, play for to me it would be to play for the 200-day MA, and then maybe even higher. I don't know that this would hold it if it broke the down channel. I think that there could be a really violent short covering move because no one would be expecting it, and you could even get back up to like the 245s areas. So that's my thinking on Tesla. Anyhow, I hope you guys enjoyed the video. Please hit the like button if you liked it. Be sure to check out my risk management video. I'm going to post the link down below in the description, and let's have a good week. Be sure to follow me on Twitter. My handle is @JustinPulitzer. I respond to questions on there fairly quickly. So let's have a great week, and cheers.